All right. For more on what to expect out of tomorrow's jobs report, let's bring in Chris Hyzy, Merrill and B of A Private Bank CIO. Chris, great to have you with us.
Thanks, Melissa. Great to be here.
Does tomorrow's report, will it change your view of the markets and where we stand right now at record highs?
You know, I think there's a few things to parse through there. I was just listening to some of the commentary, and I agree with all. So what I have to add is the market's at an all-time high, obviously, because of narrow leadership. But what's interesting is below some of the narrow leadership, we're starting to see a change really since the beginning of August when there was some pricing in of a September cut. And that's where the small caps obviously had a big rally in August. Financials are under triple momentum right now. You know, being a cyclical growth so-called sector and with small caps acting well, granted, it's 1 month. However, we haven't seen this in a while, which means, you know, any kind of cut, if it comes, it has to be based on balanced data. And if it's really weak data for whatever reason on Friday, you could see overall movement in the market be even more than what's expected, because then, as you guys were discussing before, you might start pricing in a little bit more of a majority cut in October as well. So I think right now it's a little bit of an exhale. It's like, let's see what happens. It's clear at this point, much of the data will be more balanced in terms of supply of labor and demand for labor. And we'll probably see more of the same. Revisions, we all know what's going to happen there, perhaps. And then ultimately on Tuesday, you'll see the revisions come out as well. So we're going to buy the dip here, Melissa, if there is one.
All right. So are you? It sounds like you're bullish, basically, at this point. There's no valuation concerns. You mentioned the breadth of leadership. It is starting to show breadth, but we are still historically narrow. That doesn't concern you?
The actual concentration doesn't concern me as much because the earnings contribution of the leaders is equivalent to their market cap. We didn't see that at the peak of the last tech cycle in 99, 2000, March of 2000. The actual earnings contribution was well below 1/2 of their actual market cap. And now it's almost neck and neck. So it doesn't really concern us because ultimately, if you do further get rotation, that creates a healthier market. What could happen, though, and this is where it gets important, is the actual return on an annual basis goes down relative to what we've seen over the course of the last few years and even the last decade. You get more normal returns versus the double-digit 13, 14, 15 or higher. So overall, we are bullish. We call it an owl market, which is moving your head left and right 360 degrees to try to find confirmation every step of the way that the most important factor, which is profits, continue to accelerate, and you see revisions going up to the upside. That's what we expect.
Chris, without the government jobs, is there a shot that the jobs number where you started is a bad number and we get a 50 basis point cut in September?
Well, I'm going to start off by saying I'm not an economist or a rate strategist. However, there is a shot. I don't think that that's likely, given a lot of the data that we've seen, particularly in consumer spending, which is still solid. As you know, our Bank of America Institute has very good data around that. And we would be very surprised if you got an extremely weak number for whatever reason. We see more of a balanced number, if you will, what the consensus expects as well.